On what's brewing, alternate investment funds that invested in private markets have delivered consistent alpha generation vis-a-vis the public market equivalent, proving their investability even amid strong public market performance. This, according to a new report by Crisil Market Intelligence and Oyster Global. To take us through the key highlights of the report, joining me now is Sandeep Sinha, co-founder and co-CEO of Oyster Global. Sandeep, welcome to Startup Street. No ifs about AIFs 2.0. That's your latest report. Across the last 5 fiscals, the benchmark of equity alternative investment funds has outpaced the BSE Sensex total return index, reaffirming the resilience and importance of private markets in India's investment landscape. So, Sandeep, private capital is not only participating in India's growth story, but also shaping it?
Thank you, first of all, for having me here today. It's truly a privilege to be a part of the private markets in India today. The way the ecosystem has grown is absolutely tremendous. We have almost about 150,000 plus startups in the ecosystem today. And that truly makes us about the third largest entrepreneurial ecosystem in the world. And there's a massive shift in the capital commitments. Just about the AIFs that you were talking about, those commitments have grown almost about 86x from 2014 to 2024. We're talking about a CAGR of almost about 31.5% in the past 5 years. And when you referred about the alpha, I think this is a question that we get asked often, talking about the fact that, how has that shifted in the market, especially with the listed market giving fabulous returns. But, if you look at the real numbers, and, we did these numbers in collaboration with Crisil, the IRR of 21.5% for aggregate AIF benchmark actually significantly outperforms the listed market even today. If you compare it with the BSE Sensex TRI, it is almost about 5.4% on an annualized basis. So that makes a world of a difference in terms of anybody looking at investment in this asset class.
Okay. Now, with IPO hopes high, Sandeep, we're seeing AIFs inclining towards late-stage startups. What has been your experience? What are you picking up on the street?
A very significant shift. Actually, the whole focus is that, how do we look at the companies which are now sustainable? They have gone through the growth pains. They have gone past, a certain level of the risk return appetite. And that's where we are seeing a massive interest in the late stage funding. Overall, in terms of the numbers, about 2.5x increase. And the share of the deals in the late stage increase almost about 18% in terms of the value to 39% between fiscal and 2014 to 2024. Which basically indicates a massive maturing market. In fact, we had released a fund, an ACE fund, which basically incorporated 4 of the top tier pre-IPO companies. The interest pre-IPO has been better and higher than what we have seen ever before. Just in this year itself, we've talked about 210 plus IPOs. And if you look at the index of the companies which have gone from the private investments to, the listed market, about 35 plus companies benchmark over the last 3 years, you would see that, they have outperformed any of the indices, whether it's a small cap, mid cap, large cap, or whatsoever. So the interest is actually becoming stronger and higher.
All right. With AIFs now channeling private capital to new age companies and startups, it has increased participation by domestic institutional investors. Sandeep, if you could take us through some of the growth drivers for the AIF industry in the coming years.
So I think the biggest thing that we are expecting is the participation of the domestic capital. While we take a lot of pride in the fact that we have the third largest entrepreneurial ecosystem in the world, there is a big challenge that most of this capital is offshore capital. We're talking about almost about 70% plus capital or the 70% plus assets being owned by the foreign capital. So what we really need is the same push that we saw in the domestic listed market, where domestic capital kind of pushed in its way to give support where capital from the overseas part was not as relevant as it was a few years back. I think we need to see the same shift, whether we are talking about individual participation, whether we are talking about institutional participation. I think it will make a world of a difference the moment the domestic ownership of this asset class begins to increase.
All right. Now, Sandeep, the report also highlights rising investments from non-individual limited partners such as corporates, trusts, banks, and insurance companies. What kind of an upward trend are we seeing here, and what kind of an impact do you see it making on the startup ecosystem?
I think there are 2 threads to that. One is in terms of the percentage participation from the institutional side. I think that is growing fairly well, almost about 65% from the institutional side. But I think when we talk about the overall volume contribution or the actual AUM contribution, I still think there are lots of restrictions which are holding back, the banks, the insurance companies, and so on and on. Whether it's a 3% restriction on the overall AUM of the company, whether it's a 5% restriction on the total size of the fund, I think we genuinely need to see a little bit more relaxation in terms of the norms that institutional capital can invest in this asset class. And I think that will begin to change the wheel. Globally, we see that number to be almost about 15% to 20%. In India, that's like less than 5%. And I think that shift will make a monumental difference to this asset class.
All right. One final question before I let you go. The union budget is right around the corner. What is your big ask, Sandeep, for the sector?
I think we have seen some positive shifts already in terms of the long-term capital gain that we saw the year before. One particular phenomena I think that will make a world of a difference is the whole world of accreditation. I think if we can, normalize how we kind of go forward with the accreditation, we reduce the barriers, we make the process all digital, we allow more and more individuals to participate in the process. And what will happen as a result of accreditation is that, the 1 crore minimum ticket size, which restricts the number of people entering this asset class, will actually go down to about 25 lakh rupees. And that investment can also come over the next 3 to 4 years. So this asset class, which we talk about, a high return asset class, will typically be a far more accessible instrument in the hands of the broader audience. And I think that's what we need, democratization in this asset class.
Well, on that note, it's time for me to wrap up our conversation.